Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Eli Lilly.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we jump into the actual analysis today, I just want to mention a really useful chart tool for you guys, whether you're investing or trading.
Yeah, it's definitely worth checking out.
Right. So if you want some help reading your trading charts a bit more clearly, you can check out VIP Algos. The link is below in our description.
It's super handy.
It really is. I mean, VIP Algos is basically a TradingView indicator suite. It displays these visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even like take profit and stop loss planning areas.
And it works on pretty much everything, right?
Yeah, exactly.
Yeah.
Multiple markets, stocks, Forex, crypto, gold, futures, you name it.
Sure.
But, just to be super clear, VIP Algos is strictly an educational chart analysis tool.
Right. Not financial advice.
Exactly. It is absolutely not financial advice.
Yeah.
It doesn't place trades for you, and it obviously does not guarantee profits. Trading always involves real risk, so, manage your risk carefully and definitely do your own independent research.
Always.
And just so you know, that is an affiliate link in the description, so we might earn a commission if you use it, but at no extra cost to you.
All right, let's talk about the absolute earthquake that just hit the market yesterday. I mean, Eli Lilly added the equivalent of an entire S&P 500 company to its market cap in a single afternoon.
Which is just wild to even think about.
It really is. The stock jumped 6.3%, rocketing up to a brand new all-time high. And, we aren't talking about some tiny speculative tech startup here.
No, not at all.
This is a massive, highly established pharmaceutical giant. To move a company of this sheer size by 6.3% in just a few hours, that requires an absolute ocean of capital.
Yeah, it's heavy, heavy institutional capital, and they're repositioning themselves in a very deliberate way right now.
You think it's a broader rotation?
Well, we're definitely witnessing a major rotation. Institutional money is, they're currently fleeing those high beta speculative assets. They're looking for shelter.
Right, but they don't want to just sit in cash.
Yeah, exactly. They don't want stagnant safety. They are aggressively hunting for what we call defensive growth. And Eli Lilly is absolutely leading that charge right now.
All right, let's move into the wealth building context because, defensive growth is such an interesting concept. It honestly usually sounds like an oxymoron to me.
Yeah, it kind of does.
Right, like you either get safety or you get explosive growth. You very rarely get both at the same time. But I want to look at this strictly through the lens of a long-term portfolio strategy.
Okay, yeah.
Because a massive afternoon pop is great if you're day trading, sure. But if we're looking out over a multi-year horizon specifically, the next 12 to 24 months, we have to ask a hard question.
Whether it's actually sustainable.
Exactly. Is this actually a secular growth compounder, or is it just a temporary momentum trade?
Well, when you stretch your time horizon out to that 12 or 24-month window, the thesis actually gets a lot stronger. You really have to look at their runway.
You mean the patents?
Yeah, exactly. Their primary patents for their major incretin therapies, which are basically the foundational drugs in their whole weight loss and diabetes portfolio, those run all the way out to 2036 in the U.S.
Wow, 2036.
And 2037 in Europe. So you're looking at over a decade of exclusivity.
Which is undeniably a massive moat. But I have a hard time wrapping my head around this specific market. Like, you always hear this company's dominance compared to a tech monopoly.
Right, people compare them to the early days of smartphones or search engines.
Exactly. But let me challenge that analogy for a second. With a tech monopoly, the switching costs for the consumer are incredibly high. You buy a phone, you're totally locked into the operating system, the cloud, the apps.
Yeah, it's a huge headache to switch.
Right. But with a pharma company, a competitor in some lab across the world can literally just invent a slightly better molecule tomorrow, and poof, your entire monopoly vanishes.
That's a fair point.
So isn't there a risk that we are basically taking this massive short-term societal weight loss fad and, treating it like a permanent portfolio anchor?
See, that is the absolute crux of the debate right there. But I think calling it a weight loss fad slightly misrepresents what these drugs actually do mechanically.
How so?
Well, this isn't like a dietary supplement. It is a fundamental structural medical intervention for metabolic disease. the actual physiological effectiveness of their GLP-1 and GIP dual agonist therapies.
Wait, dual agonist meaning what exactly?
Meaning drugs that stimulate two completely different hormone receptors in the body simultaneously. So they regulate blood sugar and appetite at the same time. The effectiveness is just unprecedented.
Okay, but what about the competition inventing a better molecule?
Well, here's the thing. The long-term clinical data is now supporting its use in cardiovascular health and even sleep apnea. So, Eli Lilly isn't just selling one single lifestyle drug. They're basically building an entire therapeutic ecosystem around metabolic health.
Ah, I see.
So competitors aren't just trying to beat a weight loss number anymore. They have to match the cardiovascular outcomes, the safety profiles, the massive manufacturing scale. It's a really formidable wall to climb.
Now let's look at the fundamentals. Because if we're going to claim they have an ecosystem that rivals a tech monopoly, the raw numbers have to back it up.
Oh, they definitely back it up.
You really can't fake the numbers. And looking at Q1 2026, it's frankly staggering. Worldwide revenue hit $19.8 billion.
Yeah.
That is a 56% increase year over year.
And, the bottom line shows something even crazier. Non-GAAP earnings per share actually surged by 156%.
Wait, 156%?
Yeah. And I want to pause on that because you very, very rarely see that kind of operating leverage in a mature mega cap company like this.
Operating leverage meaning, for the listeners, meaning that their profits are growing exponentially faster than their revenue.
Right.
Once you cover the fixed costs of R&D and building those huge manufacturing plants, every single additional pen of medication they make is just highly, highly profitable.
Right, because the initial cost is already paid for.
Exactly. And the driver here is a massive 65% volume surge in their flagship GLP-1 therapies, Mounjaro and Zepbound.
The demand is just insane.
It's so voracious at the pharmacy counter that management actually raised their full year 2026 revenue guidance by a full $2 billion.
Wow.
Yeah, they're now modeling between 82 and 85 billion for the year.
It's a historic revenue ramp. There's no question about that. But what I find even more revealing is how they're deploying all that capital.
The M&A activity. Yes. They're generating this immense free cash flow, and they aren't just letting it sit there on the balance sheet or just buying back stock. They are executing incredibly aggressive mergers and acquisitions.
Yeah, they've been busy.
Just in the first half of 2026, they earmarked over $25 billion for M&A. And if you look at the targets, it connects directly back to that therapeutic ecosystem concept you just brought up.
Right, the sleep disorders.
Exactly. They spent $7.8 billion to acquire Centessa Pharmaceuticals, which is specialized in sleep disorders.
Which makes perfect sense. I mean, if you cure the obesity, you profoundly impact the sleep apnea. By acquiring a sleep disorder company, they basically own the entire clinical journey of that patient.
That's a great way to put it.
And it doesn't stop there. They took over Ajax Therapeutics for $2.3 billion and dropped $7 billion on Colonia Therapeutics in the oncology space. They're funding an absolute pipeline right now.
Yeah.
Like 42 active phase 3 clinical trials.
42 active phase 3 trials is an armada of clinical development. But, I want to zero in on the absolute crown jewel of that pipeline, which is retatrutide.
Oh, the data on retatrutide is wild.
It is. The phase 3 trials demonstrated a 28.3% mean weight loss.
Yeah. And to really understand why that specific number is shaking up the medical community, we have to look at the actual mechanism.
Right. How is it different?
Well, the current market leaders are dual agonists, like we talked about, but retatrutide is a next-generation triple agonist.
Triple?
Yeah. Think of it as hitting 3 distinct metabolic switches in the brain and the gut simultaneously. Older therapies only hit 1 or 2. So hitting nearly 30% weight loss, that crosses a major threshold.
How so?
It is effectively encroaching on the physiological results you'd only get from bariatric surgery,
Yeah.
but entirely in a non-invasive pill or injection form.
Which, sounds flawless on paper, but as an analyst, I'm always looking for the crack in the armor, right?
Oh.
And in their financial breakdown, there is one very specific metric that went the wrong way. Despite this massive 56% revenue jump, their non-GAAP gross margins actually contracted.
They did, yeah.
They shrank by 0.9%, dropping to 82.6%. Now, don't get me wrong, 82% is still a wildly profitable gross margin.
Massive.
But structurally, in a period of hypergrowth, you really expect margins to expand, not shrink. And the data shows this was due to lower realized drug prices.
Right.
In the pharma world, dropping prices to move volume often sparks a total race to the bottom. So isn't that margin contraction a pretty bright red flag for the overall quality of the business?
That's a totally fair observation. I get why you'd flag that. But in this specific context, it is a highly deliberate strategic trade-off. It's the classic volume trade-off.
Okay, walk me through that.
So yes, realized prices came down slightly across the board, but you have to look at where that volume is actually coming from. It's specifically the adoption of their oral GLP-1 therapy or...
The pill format.
Exactly. And the data shows that 80% of the patients starting that oral pill are entirely new to the GLP-1 class. Like they have never taken an injectable obesity drug before.
Ah, so they are capturing an entirely untouched demographic here.
Precisely. The pill format completely removes that psychological barrier of giving yourself an injection. So the company is willingly sacrificing just a tiny fraction of a percentage point in their gross margin today to capture massive, sticky, long-term market share.
Basically trading a penny today for $1 tomorrow.
Exactly. They're onboarding millions of net new patients into their ecosystem.
That brings us to the catalyst timeline. Because if we are modeling this out, those new patients are going to be driven by very specific upcoming events on the calendar.
Definitely.
And the absolute largest catalyst staring us in the face is July 1st, 2026. This is when the Medicare GLP-1 Bridge program officially launches.
That's a huge one.
For eligible seniors, it caps the out-of-pocket costs for these therapies at just $50 a month, and that runs all the way through December 2027.
Yeah, that July 1st date, honestly, cannot be overstated. When you drop the out-of-pocket cost to just $50 for the senior demographic...
Which is huge.
Right, and it's a population with an incredibly high prevalence of metabolic and cardiovascular conditions anyway. You are essentially neutralizing the single biggest bottleneck in this entire industry, which is affordability.
Right, because normally these are expensive.
Without coverage, these drugs can cost upwards of $1,000 a month. So dropping that to $50, it totally removes the friction. We are going to see an absolute avalanche of new volume hitting pharmacy counters in the second half of the year.
Which naturally leads right into the upcoming Q2 2026 earnings, right? The exact date is TBA. But there is already a really loud expectation in the market that management is going to have to raise their guidance yet again.
Because of the accelerated adoption.
Exactly. The adoption rates we're seeing with the oral formulations ahead of that Medicare unlock are just huge. Plus, looking at the second half of 2026, we also have the official launch of the sleep apnea label expansion for Zepbound.
And don't forget the final decision from the European Commission regarding Jaypirca for chronic lymphocytic leukemia.
Right.
It's basically a cascading fundamental tailwind. You've got this massive Medicare pricing unlocked domestically, potential earnings guidance hikes, new label expansions allowing totally new patient populations to get insurance coverage, and regulatory approvals overseas. The fundamental story is relentlessly bullish.
Okay, but let me play the skeptic again here.
Go for it.
Wall Street is highly efficient, right? And this July 1st Medicare Bridge program is super publicized. I mean, it's literally national news.
Oh, yeah, everyone knows about it.
So if Wall Street already knows about this impending avalanche of Medicare volume, shouldn't every single penny of that future revenue already be priced into the stock? I mean, we just talked about the stock hitting a completely uncharted all-time high yesterday.
Right.
Now let's pivot to the chart. Just to see if retail investors are basically showing up late to the party, let's look at what the institutional money is actually doing.
And you know, the technicals answer that question beautifully. Yes, the stock is at an all-time high, but a high price doesn't automatically mean a stock is expensive or topping out.
Okay, how so?
Well, we're looking at a classic bullish breakout from a pretty prolonged period of previous consolidation. When a stock breaks out of a multi-month sideways range like this, the underlying mechanics tell a very specific story about institutional conviction.
And I'd say the most telling metric on the chart right now is the relative strength line, or the RS line.
Definitely.
For anyone unfamiliar, the RS line measures the stock's performance directly against the broader S&P 500 index. And right now, those RS lines are making new highs right alongside the stock price.
Which is exactly what you want to see.
Right. It means the stock isn't just drifting up because the whole market happens to be up. It is actively, significantly outperforming the broader market. In technical analysis, that divergence is the classic hallmark of heavy institutional accumulation.
It's a tug of war, and the buyers are decisively winning. Big institutional funds are accumulating these shares aggressively. And importantly, If you just look at the volume bars at the bottom of the chart,
The volume is massive.
massive. And it's entering the stock directly in response to real, fundamentally bullish catalysts, like the Medicare inclusion and the European regulatory backing.
So it's not just hype.
No, this isn't speculative fluff. It's not some meme stock rally driven by social media. This is conviction buying, plain and simple, based on forward cash flow projections.
Makes sense.
And honestly, it really highlights why having clear visual tools to map out these breakouts and identify where institutional support actually lies is so critical when you're trying to scan volatile markets.
I hear you, but I'm still instinctively cautious, honestly. Buying a stock right as it breaks to a completely new all-time high, it always just feels incredibly risky.
Oh, it feels terrible.
Right. You are literally paying the highest price anyone has ever paid in the entire history of the company.
It feels incredibly counterintuitive because human nature tells us to wait for a discount, right? Wait for a dip. But historically in the stock market, breakouts that are accompanied by high relative strength and massive institutional volume, they actually signal the beginning of continued momentum rather than a top.
Because they're repricing it.
Exactly. The market is constantly repricing the asset based on the new reality of that future cash flow. When the fundamentals expand this rapidly, the old technical ceilings simply have to break to accommodate the new valuation.
So what does market sentiment look like? Because if the technicals are showing this level of institutional buying, the narrative and sentiment must be overwhelmingly positive to actually support it.
Oh, it is.
Yeah, looking at the current news flow, the top 5 recent stories driving the stock are just universally bullish. It's a steady drumbeat of regulatory milestones, clinical trial successes, and major analyst upgrades.
The analyst community on Wall Street is leaning in very hard right now. Like, Lear Inc. recently raised its price target to $1,232, maintaining an outperform rating.
Wow.
But there is also independent analysis out there right now, modeling a target of $1,348.
Over 1,300.
Yeah. They're arriving at that number by applying a 26 times price to earnings multiple to projected 2028 earnings.
Okay, applying a 26 times multiple to earnings that won't even materialize until 2028. That is looking 2 to 3 years into the future.
It is far out.
Why look so far out? Isn't the market getting just a little too euphoric here? Because when sentiment gets this universally positive, it usually means perfection is basically priced in. And any slight delay in a clinical trial or a minor earnings miss is just going to be punished brutally.
Well, euphoria is always a risk you have to monitor, no doubt about that. But markets are inherently forward-looking mechanisms. They price in the future, not the past.
Fair point.
You really have to anchor that enthusiasm in the institutional flow we just saw on the chart. Big fund managers aren't retail traders buying on a whim, you know. They're deploying billions of dollars based on hard math and actuarial tables.
Right, they've done the math.
Exactly. The fact that the RS lines are hitting new highs proves that these funds view the stock's future earnings visibility, especially from that Medicare bridge and the pipeline depth, as secure enough to actually justify that premium 2028 valuation.
And the clinical sentiment is definitely backing up that optimism. We just saw positive phase 3 results for a J-PIRCA combination therapy. It showed a 45% reduced risk of disease progression or death in relapsed chronic lymphocytic leukemia.
Which is incredible news for patients, first of all.
Absolutely. But what I find really fascinating, and this speaks directly to the long-term wealth-building strategy, are the speculative rumors flying around right now.
Oh, the neuroscience stuff.
Yes. They recently signed 2 massive partnerships. One is with BioArctic for up to $800 million, and another with AlzeCure for up to $1 billion. There is highly credible speculation that they are quietly building a massive neuroscience platform.
Which is just a brilliant, necessary strategic move. I mean, they are taking the absolute mountain of cash generated by the weight loss boom, and they're using it to diversify their revenue streams, potentially eyeing massive breakthroughs in Alzheimer's and neurodegeneration.
Now let's talk about the risks, because that exact need to diversify perfectly highlights the glaring bear case for this company, which is concentration risk.
Right. It's the elephant in the room.
No matter how good the story is, we have to look at what could break the bullish thesis. Currently, approximately 2/3 of this company's entire revenue relies on just 2 brands, Mounjaro, and Zepbound.
2/3 is a lot.
It's massive.
Yeah.
If a competitor somehow manages to bring a superior therapy to market or, an oral pill that works faster with fewer side effects, Eli Lilly could face absolutely devastating market share losses.
Concentration risk is definitely the primary fundamental threat here, but I'd argue it is heavily mitigated by two factors.
Okay, what are they?
First, the competing therapies currently in the market, or even the ones nearing the market, are at best only on par with what Eli Lilly already offers. Nobody has successfully leapfrogged them yet.
True.
Second, Eli Lilly is actively leapfrogging itself. Their own pipeline, especially with retatrutide hitting that 28.3% weight loss mark we talked about, is vastly superior to the competition's current pipeline.
So they're beating their own records.
Exactly. And as we just discussed, the aggressive M&A strategy into oncology and neuroscience is actively diluting that concentration risk quarter by quarter.
Okay, fair point on the clinical side. But there is a massive risk that they simply cannot out-innovate, and that is the United States government.
The IRA.
The Inflation Reduction Act, the IRA, is a very real, looming threat. It grants the government the power to forcefully set and negotiate prices on mature drugs. We already saw a diabetes drug, Jardiance, take a brutal 66% price cut under this legislation.
Yeah, that was a heavy hit.
And Trulicity and Verzenio have already been selected for price cuts starting in 2028. So could government regulation essentially throttle this entire growth narrative by just capping what they're legally allowed to charge?
I mean, the IRA is undeniably the heaviest anchor weighing on the entire pharmaceutical sector right now. It's a massive risk. But the GLP-1 market possesses a highly unique defense mechanism against this.
And that is?
It goes back to the concept of volume elasticity of demand. Think of the current high price of these weight loss drugs as a dam.
Yeah.
That dam is currently holding back millions of patients who desperately want this structural medical intervention, but they simply cannot afford it. If the government forces them to lower the price, they are essentially just opening the floodgates.
So lower price equals way more buyers.
Exactly. The water level, meaning the price per unit, drops significantly. But the sheer volume of water rushing through powers the turbine twice as fast. Because the total addressable market for obesity and metabolic disease is so astronomically large, a lower price will likely drive disproportionately higher volume.
So they make up the difference in scale.
Right. They make less profit per individual pen, but they sell tens of millions more pens. It acts as a natural financial hedge against the regulatory price erosion.
So with everything on the table, what's the final verdict? We've unpacked a fundamental moat built on clinical superiority. We've looked at incredible technical breakouts backed by institutional accumulation, and we've weighed the real threats of government price setting and concentration risk.
Based on the comprehensive analysis, the final bullish score comes in at a very strong 9 out of 10.
A 9.
Yeah.
Wow.
The elevator pitch is basically this. Eli Lilly is executing a historic revenue ramp, driven by a currently insurmountable lead in the GLP-1 market, and they are actively neutralizing their concentration risk through highly aggressive targeted M&A, all funded by massive free cash flow.
And timeline-wise?
From a horizon perspective, this remains a very strong multi-year hold, specifically looking at that 12 to 24-month window. The main upside drivers over that period will undoubtedly be the July 2026 Medicare Bridge program and the accelerated adoption of their oral formulations.
Of course, for cautious investors, that heavy reliance on the GLP-1 franchise and the looming shadow of the IRA are real risks that require constant monitoring. And, it is crucial to state explicitly that this analysis is not financial advice.
Definitely not.
We are simply breaking down the catalysts and the data, but you must always do your own research and manage your own portfolio risk.
Absolutely.
And if you want a cleaner, more efficient way to read your trading charts and manage that risk, check out VIP Algos through the link below in our description. VIP Algos is a TradingView indicator suite equipped with visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas.
This is super helpful.
It really is. It can genuinely help make charts easier to scan and analyze, but again, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk appropriately. This is an affiliate link, and we may earn a commission if you use it at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.
As we wrap up today, I just keep thinking about that $50 a month Medicare cap. When a structural medical intervention that can genuinely alter human physiology becomes cheaper than a monthly gym membership, Well, does that just change the pharmaceutical landscape, or does it fundamentally change society itself?